Which internet stock would Warren Buffett buy? Using the value formula, as a review of the value formula, Warren wants to get the most value for the least price. What he considers, so we divide the value by the least price to get a ratio of value to price. The value he considers net earnings, which he calls retained earnings. The net earnings is the money that's left over at the end of the year, the percent net earnings. And the dividend is the percentage that they will pay you based on the stock price. So if you add these two percentages together, you get the value, and you divide it by the price to book, not the price of the stock, but the price to book, which is a ratio of how much you're paying for the assets. So if we look at these internet stocks, this value to price ratio, that scores more than 10, the stock should double, scores less than 2, the stock should fall, and scores in between 2 and 10, we just don't know if it'll go up or it'll go down. But this is all, of course, based on the net profits maintaining stable. So if we look at Yahoo over the last, here in July of 2009, Yahoo has lost 2.6%. None of these companies pay dividends. And so you divide by the price to book of 1.8, which is 80% more than the assets, and you get a negative score of 1.5. So Yahoo should fall. In fact, because Yahoo's net earnings have been falling, they've been actually coming down for a whole decade. eBay, on the other hand, they have a strong net earnings, they don't have any debt, and they're selling for 89% more than the assets. They come out with a whopping score of 10.5. And this formula tends to get that stocks over 10 when this price to book falls. When the price falls of the stock, you buy into these dips. Which stocks do you buy? You buy the ones that have strong net earnings where the ratios are more than 10. These companies tend to have little debt, and sure enough, eBay has very little debt. In fact, I don't think they have any long-term debt. Google, they have a 19.6 net profit, but they have you're paying a premium for the strong company of 4.38 times the assets, so their score is average. We don't know if they'll go up or down. Amazon has a good net profit, but they have a very, very high price to book of 11.4, so the score of 1.1 means that they should actually fall with this formula. Netflix has a very high price to book. They're also less than 2.9. They should also fall. IACI, Interactive Corporation that owns Ticketmaster, they've recently fallen because their loan division was losing money, the real estate division of Interactive Corporation. So they only have a price to book of 0.53. So they're still profitable with a 7.45% net profit in July 2009, even after 2 years of the real estate having trouble. So they have a whopping score of 14. I think Warren, if he were to buy an internet company, he would be attracted to this low price to book for a company that when the loans do strengthen again and this net profit goes up, this also Interactive Corporation has a lot of cash and little debt, so they're conservatively financed, that this stock is just bound to go up, and it will, of course. This stock of IACI will go up. iNet, Internet Brands, they have a very good net profit, cash on hand, they don't have any long-term debt, and they also are selling for less than the price of their assets, 92.92, 92% of the assets, so they have a score that's greater than 10. Internet Brands, Interactive Corporation, and eBay, according to this formula, should go up in price. Double or even triple quite easily, when the other ones will struggle because of the high prices. This has been Alan Kendall. Have a nice day. Bye-bye.